Hi everyone. I'm just going to give a few minutes before I start, just to let people log in and set up their computers, etc. So I'll start in about 1 or 2 minutes. I don't want to wait too long because there's quite a bit to go through, and I want to make sure, obviously, that we spend time on the things that are relevant. Why people are here, basically, where to invest, where not to invest, what's going on in the world, all these sorts of things. So I'll give everyone a minute. I can see there's people attending very quickly. We've now got 10 people online, which is good. So yeah, I'll just give everyone a minute and then I'll start at about 1 minute past. Okay, so it's 1 minute past. We've got, what, 9, 11, 12 people on now. We had over 50 register, actually, so I don't want to wait too much longer, though. I think I'll start. The first few slides are quite introductory anyway, so those that are late, they're not going to miss much. The best stuff's towards the end anyway, so let's start, shall we? So today's seminar is, should you invest now? And if so, where? I think everyone knows the economy is in quite a bad shape, but markets keep going up, or certainly have been, with the exception of a few pretty bad down days. So what's going on? This is hopefully what we'll address today. So just very quickly, hello, that's me. You can all see me on video anyway. I don't know why I keep putting the picture on these slides. Anyway, look, that's my contact details. Feel free at any time, whether you're a client or not, to contact me via email, via phone, use WhatsApp and Zoom, obviously, and various other modes of communication. So just drop me a message anytime where you have any questions or anything like that. So today's agenda, like I said, I'm going to give a couple of minutes, just let everyone, log in and get their computers set up or phones, etc. But the basic agenda today is I'm going to do a very short introduction, talk only very, very quickly on the COVID-19 scenario. I think we're all a bit over informed in this area. And then, of course, what are the effects on the markets, on the global economy? What's IPP been doing? What's our performance and our advice at the moment? And then the key area, which I think everyone's interested in, when and where and how to actually invest today. Should you be investing? Should you be waiting? And where should you invest? Where should you avoid? So I think this is the key area. And then we'll have some time for Q&A. Last time, I think we overran quite a bit on Q&A, which is fine, but I want to start that at least 10 minutes before the end to give people a chance to ask questions and hear the answers as well before they have to go at 6. But we will run this for longer. Okay, so that's the agenda. I think if we just move on a bit while people are still logging in, very quickly, most of you I see on the registration list, I know already, and are clients of IPP, not everyone is. So us in a nutshell, we were founded back in 1983. We've got 50,000 clients all around the world, and we're currently managing around $2 billion of client assets. We're actually the first ever financial planning company licensed in Singapore. So we're still here and we're still going strong. Our services range from personal to high net worth, right through to corporate advisory. I guess the core of what we do is based around investing and investments, or wealth management, if you like. And of course, that's what I'm going to be focusing on today. So the most important 2 slides now, yes, 2. Apparently 1 disclaimer slide, not enough, according to my compliance division. I'll let you read this, it's very important. Like I said, there are 2 slides. I guess basically, you know, if you go and make your own investments off the back of what I've talked about today, without consultation, without getting advice, if things go wrong, you know, don't blame me, don't blame IPP. But of course, if things go well and, you know, what we've said today actually helps, which I hope it does, please do feedback, please do, you know, give us some credit. And we'll begin. So it's uncertain times. Generally, you know, personally, it's been pretty challenging, right? The last few months, all very unexpected. You know, you've had lockdowns, people feared for their lives, for their health, for their family. So it's been a very, very uncertain time with this pandemic that's been going around. And of course, that uncertainty filters through into the economy and the stock market. So of course, for investing as well. So the great lockdown, we're actually 3, or most of us around the world are 3. I know there's people not based in Singapore online right now, but generally we're coming out of this lockdown, or circuit breaker, as Singapore called it. The IMF actually coined the phrase, the great lockdown. I think this will be with us for many, many years. I think the next generation will look back through history and, you know, there will be records of this great lockdown. And it's, yeah, just been extraordinary. Anyway, like I said, we're gradually getting free. What does the lockdowns mean? Well, it started with supply chain disruption, obviously because of China. China was the first to be really impacted with COVID-19. Subsequently led to a demand freeze as we all get locked down or working from home. WFH, I think, are 3 letters that, you know, are going to be with us. People keep talking about this new norm. Now, whatever that actually is, I think work from home is going to get more and more relevant. Obviously, social distancing, personal hygiene, etc. And I mentioned about bankruptcies. There have been some. I expect there to be quite a bit more, to be completely honest. And we'll come on to that a bit later. So in Singapore, we had the circuit breaker. We're now right through, finally, into phase 2. Touch wood, so far so good. And we're all enjoying a bit more freedom and going back to work, maybe not completely, visiting restaurants, seeing people again. It's good, and can't wait for phase 3, although I don't think it's going to be here anytime in the next week or 2, unfortunately. But anyway, so just very quickly on some big numbers, 2 big numbers I've got for you. The first is this one, so nearly 8.8 million. This is the worldwide confirmed cases. Okay, this is from the European Centre for Disease Prevention and Control. When I did the last webinar, roughly a month ago, this was at about 5.5 million. So, you know, the case count has continued to go up, for sure. It's pretty big. Another big number, a very, very sad number, is this one. This is actually the number of confirmed deaths from COVID-19 from the same source. This is as of the 21st of June, so of course these numbers, you know, probably will have changed a little bit. Now, it's a very big number, it's very sad. I think a lot of people make comparisons with the Spanish flu. You know, this was in 1918. I don't think it's a good comparison. The world is very, very different now. But for perspective's sake, that had, well, no one really knows the exact number, but had roughly 50 million deaths worldwide. Like I said, it's not a great comparison. A completely different comparison, when you do talk about deaths, 50 million is a big number. According to the World Health Organization in 2019, 57 million people died of road-related injuries. So, you know, that's a significant number. Anyway, this is not me. I know it says this is me. This is not me. I'm not a scientific medical expert. I know there have been lots of people that have become experts during this lockdown. Yes, I'm not, and neither is this guy. He's got all the gear and no idea. He's not even wearing gloves. Anyway, so that's just my own disclaimer, I guess, to say that, you know, these are some stats, but I'm far from being any sort of medical expert at all. The last stats I just want to put, because I do think it is relevant. Like I said, Spanish flu is a different era altogether. But looking at the US CDC official statistics on seasonal flu, this is this year, or I say this year, they run it from October to April. That's the seasonal flu season in America. And of course, COVID-19 is far higher, but you can see actually seasonal flu is very significant still. 740,000 hospitalizations. Of course, that's much less than the COVID cases. 62,000 deaths. And well, I'll just leave you with these numbers to think about. The mathematicians in the room or on this seminar will note that actually the death rate for flu and flu-related this current season is about 8.4%, you know, of hospitalizations, whereas for COVID it's about 5.3. So again, some interesting stats, probably a more relevant comparison, I'd say, than looking at the Spanish flu. Anyway, so enough on all that. What about the economy and the global stock markets? How has all this affected our investments? I think we all know the answer. It wasn't too long ago, or it does seem like a very long time ago. Back at the second half of February, we started to see stock markets fall, crash, in fact. As you can see here, this is back in the 19th of February, right through to the 23rd of March. So only really 1 month, we saw a minus 33.64% change in the MSCI. This means all country world index, global stocks basically. And you can see also the S&P 500 on here, which is the benchmark for America. Yeah, pretty big crash. Scarily, very fast as well. Like I said, less than 1 month. So what happened? I haven't actually updated this slide since my webinar in May. So those that saw the last one, I haven't changed it. It just keeps changing too quickly, to be honest. In short, it's these numbers, but the EU has obviously increased. Last week, they announced they're going to increase their bond buying package, I think by 600 million euros. Sounds like a big number. It's all lost in all of this. You know, the total EU fiscal response to the pandemic is 3.2 trillion. I mean, these are just mind-boggling numbers. The US as well, just pretty much confirmed, we're waiting for the details, but they've confirmed that they're going to make a second economic impact package, which will be very significant if you believe Donald Trump. Not going to talk politics today. And again, just putting perspectives into place, you can see Japan and even us, Singapore, very small country, a number of stimulus packages. Japan's is 20% of their economic output, and Singapore's has so far been 19% of GDP. This is really huge. These are massive numbers. China, interestingly, has actually done relatively little so far. Interesting. Anyway, so these responses came, and to be fair, they were very fast, very decisive, very big, obviously, and they worked. They worked. Stocks surged. So you see this bottom back on the 23rd of March. We've seen, okay, they've come off a little bit recently, but we've seen a really quite significant increase back up, 44.9%. Obviously, it's not a full recovery because you need more than 50% to get back to where it was before. But that's massive, 45%. And again, the time frame, it doesn't look steep in this chart because of the overall time frame, but you know, we're talking about just a few months. It's really, really just everything's moving so fast and quick these days. To show you the whole thing, so again, from the start of the crash, and then the subsequent recovery through till now, Again, you can see pretty much everyone's doing the same thing. The red line is the S&P 500, the blue line is the MSCI All Country World Index. I didn't put on here the NASDAQ. I'm sure you would have all seen in the press, it actually reached new highs about 2 weeks ago now. But yeah, this is a probably more broad-based, like I said, benchmark for global stocks and also for the US stocks. What was interesting about here, whilst this looks quite smooth, even though we know it's a fast rise, we haven't recovered. Like I said, we need 50% to go back up from the losses that we saw. We didn't hit that. But also the VIX volatility is very high. It's still at 33. Really, you need it to be below 20, ideally around 15, 16 to confirm the end of the bear market. So we'll see. Maybe it's not quite the end yet. We'll discuss that more later. The VIX, incidentally, is a 30-day forward-looking indicator. So it suggests we've got at least one more month of pretty big ups and downs to continue. So in amongst all this, what did we do? How do we add value? That's what's happened. You know, what do we do? This is our investment process. Just a quick, we're in Singapore, we have to have an acronym, FTQ. This is our sort of investment methodology, if you like. Simply F, fundamental. We look at the fundamental state of the economy and global stock markets. T for technical, we also use technical analysis, and Q for quantitative, which we base on historical data. Interestingly, our investment division doesn't look at the MSCI World or S&P 500 too much when it looks at this. They actually use the Dow Jones Index. The reason for this is it's just got the longest history, the most data. You've got over 100 years worth of data and various different global events, actually including the Spanish flu. The Dow Jones lost about 15% in that period. But anyway, next I'm not going to compare things to that. But what did all this FTQ, you know, what did this lead us to? So when we looked at the Dow Jones, we looked right back through more than 100 years. And what we found is that a minus 50%, like the GFC in 2008, 2009, it's a 1 in 50 year occurrence. Smaller corrections, a correction is more like 15%, is 1 in 3 years. Technically, a bear market is more than a 20% loss, that's 1 in 5 years. And once in 10 years, we get a minus 30%. And usually recession-led or expectations of a recession-led decrease. So that was what the real historical data showed us. To put that into perspective on the chart, you can see this was the recent peak in February. The Dow Jones went right down to minus 37%, in fact. So you can see where these different 15, 20, 25, 30, all these different sort of floors, if you like, got breached very, very quickly, quick succession, right down eventually to 37% loss. So that's the sort of putting the reductions down in perspective. So what did we do? Well, we actually looked at this, and remember, minus 30 is a once in a decade opportunity. We actually added equities. So across all of our risk profiles on the 16th of March, we added 10% to equities. It doesn't sound like a lot, but it's a house call from our model portfolio perspective, but also from our systematic investment management process as well, Eagle Eye. We manage lots of CPF money and in certain platforms, certain accounts as well. So it is quite a significant call, if you like, to make. And we were just confident, like I said, it was a 1 in 10 year opportunity. Could it have gone lower? Of course, and it did. If I bring up the chart now, you can see actually it went down even further. Our call on the 16th, you can see here, which is the green dot. So I've actually put MSCI World here, so it's minus 29, but the Dow was more than 30. And that's exactly 1 week before the bottom. So look, with hindsight, that was a pretty good call. I think that was very reassuring. It would have been nice if this was the actual bottom, and this is where this section started, but look, we can't get it right all the time. We don't get it right all the time, but actually I think it was you know, a good call. Like I said, not just with hindsight. At the time, we believed in it very strongly. What does that mean in numbers? So actually, if you've invested in global stocks generally, you're not going to be too clever trying to pick the best from the worst. You would have actually, from the 16th of March, made 30% to today. Well, all of my numbers are from the 21st of June, by the way, because I had to get all of this approved twice by compliance. But that's nearly 30%. Actually, if you waited a week later, or more likely by the time we actually do any paperwork and processes and actually make any changes, it would have been the exact bottom. You can see waiting a week and the bottom is exactly the same, and you would have made 38% returns. So was that just a lucky call? No, I know it's not, and I can tell you more about it. We can speak for a very long time on the processes that we do, but you can see in good years, like 2019 was a nice easy year. Our very aggressive classic portfolio did 22%, whereas the benchmark only did 21. The year to date to the end of May, we're actually up. We've recovered, so we're 0.1% up. The benchmark's down still, and in May itself, so when things are going up, you can see again we're outperforming. So anyway, that's our managed process. It's not available on most platforms, so we have a number of core funds, so key holdings that we like. I've plotted two here. These are probably the two most popular across all the platforms. The green line is Fundsmith Equity Fund. The orange red line is the UOB United Global Quality and Growth Fund. And then blue, just for context, is the MSCI World. So you can see outperformance from both, loss less from both, and really done quite well. You know, in this period from, this is the start of the crash, the same dates that I used before. So I'm not picking certain dates that look good. This is the dates that I used last time. You can actually see that in total, the green line, which is Fundsmith, has produced plus 2.6%. UOB's done -4, so it's still lost, but you know, it's lost less than the market, which is -8, so more than double. So yeah, pretty good. So it goes to show that picking the right strategies makes a big difference. When we start looking at this year to date now, so what about for the calendar year so far? If I go back to the start of the year, obviously we had a nice couple of months. Shame they didn't continue, but you can see again, Fundsmith is up 5.7%. United Global Quality Growth 5.2%. Global stocks is still down. So we've got some good winners here. They've been doing very, very well. They move roughly in the same way, but most importantly, they're outperforming stocks generally. So very pleasing to see that these core funds are producing. And again, for the clever people who said in January, the market's too high, I'm going to hold cash, I don't want to invest. Yes, they were clever because they missed this crash and a few heart attacks probably on the way. But you can see even with all of this, and even though the markets haven't recovered, investing in these funds, you would have made over 5% return so far, which, you know, what does cash give? Doesn't give 5%. In some countries, there's actually still a negative interest rate. And interest rates aren't going to go up anytime soon. So that's what's happened. What's going to happen next? Well, obviously, I wish I knew that. But let's have a look about what's to come. And I guess the key question, whether you already have a portfolio or, again, whether you have that cash in the bank, should you be investing now? Okay, so I'm going to quickly look at the economy versus the stock market, because they are two very different things. And I think what led me to do this talk, and what's a key talking point in pretty much every conversation I have at the moment, is why is the market going up when the economy is so bad? Well, we just look at what the stock market is. Firstly, it's forward-looking. Okay, it's looking into the future. It's very much based on earnings expectations of different companies. And again, yeah, perhaps, you know, we went too far, too fast on the way down, and people believe that, you know, the future was brighter than actually was being priced in. The economy, on the other hand, is backward looking. I think we're all expecting recessions around the world. Recession is a fall in GDP in 2 successive quarters. So therefore, you actually have to wait basically 6 months, plus a couple of weeks for the reports to come through to actually know that we're in a recession. So that's very much why there's a disjoint, and it's not unique to today. It happens many times through history, maybe just not as extreme as the scenario is right now. I've put in here as blue K. Anyone that's talked to me in the last couple of weeks or follows me online will know that I always talk about the K-shaped recovery. People talk about V's, about W's, about U's. The Nike tick is a new one. And I just feel that the K is relevant because today, I guess this is the market, and today this is the economy. That's not what it's supposed to say. I think that the notion of the K-shaped recovery is that the strong get stronger. Companies, that are doing well will keep doing well. Companies that are struggling will continue to struggle. Some will fail. And you can apply this K also to economies as well. I find it interesting. So anyway, the economy versus the market. Have we had a V? Okay, not quite, but it's still been a pretty good tick, I guess. I very much believe in the K notion. And like I said, a lot of people have been talking about the Nike swoosh, the Nike tick, which, yeah, quite possibly is exactly what we're seeing now. Either way, we've had a 40% bull run. Like I said, the NASDAQ hit new highs. China nearly did. China often gets forgotten, or it's obviously painted very badly in the press. But you can see, look, as of the 21st of June, it was only less than 3% off its pre-COVID-19 highs. Other markets have gone up a lot, but still some way to go. The FTSE's struggled. You can see Euro Stoxx 50 is actually up 42%, but it's still another 18% away from reaching its highs. Meanwhile, when we look at the economy, completely different picture being painted. Like I said, we're all expecting recessions pretty much all around. I think every country is going to fall into a recession. We'll find out in early July. Corporate leverage is at an all-time high. This is from the OECD. And interestingly, this comment was from a paper from the OECD at the end of 2019. So it's not even up to date now. This is not a good backdrop. US household debt, according to CNBC last month, was $14.3 trillion. Again, it's just a phenomenal number. When you go on the World Bank website and you look at the GDPs of countries, this number, which is the household debt in America, this number is more than the GDP of Japan, Germany, UK, and France. Not independently, collectively. If you add up all of their GDPs, you get 14.3 trillion. Phenomenal number. So I don't know if you can hear the construction. It's probably one of the downsides of the lockdown ending. But anyway, hopefully you can hear me all. So back to this. So the US jobless claims reached 44.6 million, with more than 20 million claiming ongoing unemployment benefits. Again, these are just huge numbers. 44.6 million is 3.5 times what it was at in the global financial crisis, which for many of us is a recent memory still. So yeah, it's not looking good. The markets did bounce quite recently, about 2 weeks ago, because the US jobs data was really great. I say not because I really don't think it was. I actually said on my own social media, if you follow me on Twitter, for those of you that use it, and can look past Trump's incredible tweets that he does, you can see timestamped here on the 5th of June. I just don't believe it. On LinkedIn as well, I post more in detailed stuff. So please follow me on both if you're not already. And yeah, I was just saying that the jobs data really isn't very positive to me. There's positive things in there, of course. Any numbers that change and any numbers that change that beat expectations is always welcome. But yeah, we were looking at the number of unemployed on temporary layoff. This fell by 2.5 million to 15.3 million. That's still a massive number. But the key thing that didn't make the headlines was that permanent new job losses still went up 295,000 to 2.3 million. So for me, that's not good data. It really isn't. Anyway, so you've got all of this, and I guess you've got to siphon through and work out, you know, what to believe, what's important, what's not important, and whether you invest or not to invest. That's one of the key questions for today. For me, there's only ever two reasons. It doesn't matter about today, last week, 2 months' time, 5 years' time, the day before the global financial crisis. There's only ever two reasons why you should not be investing. Okay, one is that you need money for the short term, usually within 2 years, probably within the next year, in fact, or potentially if you're retiring soon and you've already reached financial independence. These are really the only reasons. The reasons to invest, there's always some. I think today, these are all pretty important and pretty real. So if you don't have money that you need in the next year or so, you've got to remember, what's the context of all of this? We have low or even negative interest rates. Cash in the bank's not going to get you anything. And that's the same for everyone. People need returns on their money because of inflation. So therefore, this is very, very good. And when people talked about the market being expensive, this is before COVID-19, they talk about the market being expensive today. You need to put it into the context of where interest rates are, because it's always relative. And the other reason to invest, which is irrelevant really actually on what's happening in the world, is what about your own long-term financial goals? If you need to save for retirement or for your children's university fees or something far in the future, you need to invest because there is inflation. Inflation is probably going to get bigger as a result of all of this. And it doesn't matter if the market's gone up or you think it's too high. If I just put the last bull market, this came from when we did our analysis about the 1 in 10 years where we had the 30% drop. This is back in the global financial crisis. This recovery, you can see the yellow line is the S&P 500. This is 527% return. It doesn't matter if you think, oh, I've missed out, the market's gone up, it's too high now. There's a long way to go. So I just, again, always put it in context. So, okay, you look at this and think, all right, well, I'll just buy the S&P 500. I'll log off now. I don't need to speak to Ian. I don't need to pay IPP's fees. I'll just buy an ETF from the market. ETFs are great. It's always a bit of a discussion or heated argument in some cases, ETFs versus managed funds. That's it, ETFs have a place for sure. They're low cost, they offer diversification, whereas managed funds are higher cost for the same amount of diversification, actually usually less diversification in fact. But low cost or cheap doesn't always mean good. It's about value for money. So whilst many managed funds are just not worth their fees, to be honest, there are some that are. So remember the two core funds that I showed just now. That was good examples of two, that have outperformed. So hopefully we can find more and more of those, or just use those. But it's a good question because, like I said, ETFs do have a place for sure. If I just look at these two lists of companies, okay, on the left, I won't read them, you can see them, and on the right, so two different lists, all of them are in the S&P 500, by the way. When you look at these ones, and if I was to speak to you the day that COVID was announced, and if you had that hindsight, knowing that we're all going to go in lockdown, there's going to be work from home, there's going to be the supply chain disruption, there's going to be a complete demand freeze, you wouldn't really invest in any of these, I don't think. And you would probably invest in all of these. And of course, this is what's happened. When you look at Amazon today, it's up over 70% from its bottom. American Airlines, not surprisingly, in the last year is minus 58%. So yeah, you buy an ETF, you're buying all of these companies. What if we can find one that focuses on these ones? So yeah, it's not always the best option. It's a very easy option for sure. Let's go back to the K recovery that I was talking about. This has happened, like American Airlines and like Amazon, where the strong will keep getting stronger and the weak will get weaker. And this turnaround is not yet, I don't think. So yeah, you need to bear that in mind when you're doing investing, I think. So where to invest? For me, there's three things you need to look at. The first is in quality. Now, everyone that's known me for any amount of time will know that I always talk about quality investing. This is the case no matter what happens. The new norm is the case for now. What's going to happen as a result of all of this? What are the changes that we're going to see, or we are seeing already? And what about the long-term themes? So quality very simply is good quality companies. It all sounds very obvious when you think about it, but quality investing is still relatively unknown. You can't find it in a lot of academia. I even recently did a certificate on asset management with Wharton, University of Pennsylvania. No mention of quality. Everyone talks about value investing, growth investing, momentum investing, no mention of quality. But like I said, it's obvious. Companies with low debt, companies that are profitable, companies with a strong balance sheet, companies with a wide moat, that's a strong competitive advantage, or sustainable strong competitive advantage. And ones that are shareholder friendly, they use their capital effectively. ROE is return on equity, return on invested capital, return on capital employed. Three different equations, all effectively leading to the same information. So it sounds obvious. And then what about this new norm then? So work from home. What's going to happen with work from home? More online shopping, much more greater emphasis on e-commerce. The knock-on effect of that, payment processes, PayPal, I think Visa, MasterCard, these sorts of things. Logistics, we need to get the e-commerce and online shopping to our houses. Connectivity, cloud enterprise. We all know Zoom. We're using Zoom today. It's a great success story from the stock market, although it's had a few security scares and some funny stories about kids coming into the room or people not wearing underwear or whatever. I'm wearing underwear, trust me. But so all these sorts of things, cloud and enterprise. When companies are spending again, they're going to be spending on this. You got to think AWS, which is Amazon, Azure, which is Microsoft. These are very much part of the new norm, and these will continue to grow in the next few years. And what about past that? What are the long-term themes? For me, these are the key ones. Now, you can generalize it as tech and healthcare. I think both of these are kind of obvious places to invest. But going across sectors, innovative companies, which companies are going to survive? Which ones are changing with this new norm? Who's disrupting? Who's going to disrupt their various sectors? And also 5G. Don't forget 5G is still being rolled out. Obviously, it's probably going to be delayed a bit, but it's still going ahead. And it's huge. It's huge for telecom companies, for phone providers, semiconductor manufacturers. Lots of potential growth here in any stock related to 5G. And of course, the FANG stocks. This is a new acronym that's come about recently, but looking at Facebook, Apple, Amazon, Netflix, and Google. Again, obviously, they've all done pretty well. And I say obviously, I mean obviously in the context of what's just happened. I think everyone's actually probably bored of Netflix now, but certainly people that didn't have a Netflix account 3 months ago probably do today. So these are the long-term themes. I think on top of that, you could probably add in luxury. I've got a feeling that when lockdowns finally finish, people that do have money, if they've been thinking about, should I buy that watch or should I buy that expensive handbag, they'll probably just do it. I think there'll be a change in mentality after being, working from home and being locked down, etc. So luxury is probably one to watch. And a bit of a side one, animal related, our furry friends. In America, within 2 weeks of, every state had different lockdowns starting at different times, but within a couple of weeks of the lockdowns beginning, you couldn't adopt a pet in the US. They were all already adopted. Now, of course, these pets are going to need food and they're going to need treats and, all the knock-on effect of things like vets as well. So I think animal-related stuff, look up Chewy. If you haven't heard of it, again, it falls under this e-commerce section. It's just gone through the roof and it keeps going up as well. And it's basically just Amazon for pet food, basically. But interesting one. So these are some areas to invest. Again, this is just going back to that core market that we talked about, the core funds. These are both quality company investing funds. And this trend will not stop. This will continue. Quality consistently outperforms. So, and of course, it's not an accident, but they have lots of innovative companies. There is the e-commerce section. There are all the payment processes, etc. Most of the FANG are, in fact, all of the FANG are between the two. That's not an accident. Okay, so like, if you haven't invested in here, invest in here. What about if markets are too high? Again, some pretty bad numbers here, right? You can see unemployment has actually come down a little bit in the US, which is positive. But 30 million Americans have sought unemployment aid in this period. Again, as you know, I like to put things in perspective. 30 million is just huge. I think the population of Singapore is 5.8 million. That obviously includes you know, babies and domestic workers, etc. So that's a massive number. An even bigger number, the United Nations International Labour Organization, they reckon 305 million full-time jobs will be lost in this period. So it's not looking good. Again, 305 million, it's just a massive number. The entire population of America is 320 million. Yeah, it's a lot of people. So we're gradually opening up. I think we are going to hit recession, obviously, Q2 guaranteed. I mean, we'll see in a few days, but I think we all know that. Not sure about depression, way too early to say anything. One of the biggest worries for me is not just a recession, but it's the corporate earnings and the fact that companies still can't give forward guidance. Remember, the stock market is about looking to the future. It's about factoring in potential prices, potential revenue, sales, earnings, etc., earnings per share. And there's no forward guidance. For me, this is not a good sign, and it does suggest markets are too high. When we look at the debt as well, this is the third bit. I mean, the government debt it was mind-boggling in 2007, frankly. 2008 to 9 changed everything. And even from then, like I said, the numbers that we're seeing today from governments is dwarfing the GFC. It's a whole different level of debt. Companies as well, we've seen a few bankruptcies. Like I said, this is going to be a big thing. Insolvency, bankruptcy, and delinquency. I believe this has only just begun. There's going to be a lot more coming. And of course, individuals, remember that household debt in America. I mean, it's, yeah, just crazy, right? So maybe markets are too high, things are too bad. So should you wait to invest? Okay, I don't need to explain this slide. And I have already explained it, of course, right? So no, you shouldn't wait. Investing is the use of money not needed in the next year or so. So remember that. It's always about money that you don't need. If you can wait for a long time frame, it always makes sense to invest. Okay, crashes and recession are investors' best friend. It might seem unlikely that this is the case, of course, but yeah, it is, because it gives you opportunity to add more to your investment portfolios or reposition them. We've had the crash, or we've had a crash. You might have missed out on that. We're about to have a recession, so all I'd say is, you know, make sure you don't miss out again. If there's another opportunity, if you get a second bite at the cherry, don't wait. You know, it's not about timing markets. It's very much, hopefully, I've demonstrated this, it's very much about investing. We've all heard this, it's time in the market that matters, not timing the market. A bit cheesy, but stay invested. You know, this quote here is from Peter Lynch. Peter Lynch is $1 billion investor. He's responsible for making Fidelity a household name. I think he knows a thing or two about making money. So, you know, don't wait to invest. That's what I'm trying to say. If I look at this very quickly, this chart, these next two, I think I actually brought up in the last webinar, but for those that didn't make it, whoops, you can see here, basically this goes all the way back to 1999 through to the end of 2019, okay? If you'd missed the 20 best days in the market, okay, your return is pretty much flat, just 20 days. You missed the 50 best days, you're actually at minus 5.5%. There's staggering numbers. I mean, I think if I'd done it, I would have checked my calculator or Excel sheet, but this is from Morningstar, so who, you know, solid data. And then what about staying invested? So again, this looks back right through to the last two major recessions we've had, the GFC over here, and then back after the tech bubble burst. You can see here, so if you'd invested from day one, so before the 2001 recession, through to the end of 2019, you would have $311. If you were clever and only started investing, you waited for the recession to end, so you were clever, right? You were smart, you actually made less, $203. If you invest in cash, 65. I mean, cash is irrelevant. I don't need to talk about cash, but it's interesting. It's very interesting because the emotion, the logic says, well, let's wait for things to get better. But actually, you should always be invested. And I think this is a very clear message using real examples. These are the two biggest examples of recent history. So how much to invest and when? 3 ways to do it. Tranches. You know, if you're not sure, just invest, and these percentages can change from client to client, person to person, but invest, say, 40% now, maybe 40% if you see another drop in the market, or if there's actually some positive news. And then the remaining 20% if there's another drop, or there's more positive news. You don't need to do it all in one go, just do it in tranches. There's also topping up. If you already have investments, top them up. Do it today. You know, don't wait. Oh, let's wait for the market to come off another 10%. The people that did that at the start of March have missed out on 45% already. So yeah, don't forget we're always earning, or most of us are always earning money in the future as well. So the third way is you can also consider doing a regular savings plan or using dollar cost averaging. Okay, so that's weekly, monthly, quarterly amounts. Tranches can be more tactical, but then emotions might get in the way again. You do it every week or every month or every quarter, you do it systematically, you take the emotion out of it. It's a very good method of accumulating investments, but also actually benefiting from it. So just the real example of tranches, and I haven't picked these numbers to be clever. I've actually said 3rd of February, you do your 40%, so 40,000 in this example. 3rd of February is obviously towards the high, right? So like I said, I haven't cherry picked the dates. You then do it on the 16th of March because IPP said that's when you should buy equities, which as we know is here, 1 week before the bottom. And you do your last 20%, you know, a couple months later when things look like they're on the up again. Okay, so it's not, like I said, it's not picking the bottoms or the dips or anything like that. That tactic, even with all that's happened, you would be up 7.5% by the end of May. That would read probably 9 or 10% today. So it does work. If you can't react fast enough or you do get emotional, most of us is human nature, right? So another one of the core holdings that we use in some platforms where we can't access the others is the CGWM Opportunity Fund. So they have a fully flexible cash mandate, which interestingly today is at 25%. So if you can't time it, or like I said, you can't fight your emotions, use one of these managers. Let them do that for you. You can see obviously their track record, you know, of going to cash is in times of crisis. So you can see here at the end of 2008, we're in 45% cash. It's interesting. Okay, and dollar cost averaging. This is an old slide. So it actually has on the x-axis you see term in years, 10 years. Maybe this could be the next 10 months. And it's about if today you were going to invest every month or every year or every week or whatever it is, do you want to be in fund A that keeps going up, or do you want to be in fund B that actually doesn't look really very attractive? The answer is quite incredible. You can see the difference here, the investment value at the end from going into the falling one, into B, the blue one, it's really quite significant. So like I said, maybe this is not 10 years, but maybe the blue line represents the market in the next 10 months. Who knows? It's interesting. Again, it goes back to staying invested, right? Now I bring this up again, just to give you the big picture. So I didn't want to put a complicated Excel spreadsheet on here. I can send it to anyone that wants it. But I did a scenario where I did monthly investing starting from the end of April 2008, okay, so around here, every month for 2 years to the end of April 2010. Okay, so the market actually went down 13.16% in this period. But by doing these monthly amounts, and bear in mind, it hasn't recovered yet. Obviously, if you continue to hear, and you see massive returns, but it hasn't recovered yet. So minus 13% down, but with the dollar cost averaging strategy, you're up 15.5%. It's a huge difference. So it is a tactic that works, and works very well. So back to this slide, where to invest. Just a quick reminder, as I said, quality, things are the new norm, longer term themes, but also what to avoid. What should you be avoiding right now? Well, in my opinion, everything else. Again, it sounds obvious. Why would you invest in companies with high debt that don't have profits, have weak balance sheets? For me, it doesn't make sense. High yields as well. Everyone wants a yield, but don't just chase yield simply or blindly. Okay, look at, is the dividend actually sustainable? You know, what's the payout ratio? Can they keep the dividend? Are they going to reduce it? Are they even going to hold it? Which many big companies have done in the last few months. And high yield. So high yields and high yield bonds. Again, if there's lots of companies here with weak balance sheets and high debt, do you want to buy their bonds? I mean, there's a good return potentially, but there's risk. Like I said, there will be bankruptcies and many more to come. I think high profile names like Hertz, that's one of many to come. High yield, don't forget, is a new name. The original name for high yield bonds is junk. So just probably bear that in mind before you start chasing returns. For me, the risk return is much better in the equity markets. And again, probably obvious, but retail, travel and hospitality. We need to get through all this first. We've got no idea when people are going to start going to hotels again and traveling and casinos, etc. We just have to wait and see. Banks, I'd be very cautious of and I would avoid. European banks haven't learned their lessons. That's why most of them have frozen their dividend. They've got no cash. There's no interest earnings coming through. The only thing I would say is US banks are different. In America, they have learned their lessons from 2008. They're actually cash rich. And in fact, I think they're a very attractive potential place to look to invest, in fact. And value. I don't want to argue with Warren Buffett. He's obviously the most successful investor of all time. He's probably the most famous value investor. But again, if you're looking at a K recovery, a lot of companies will be value for a reason. Their prices are down because they're not very good. So you should be careful. Value also is traditionally not something for a late cycle or recession. And I think no one can argue that we're not there. So value is definitely not a place to look. But again, long-term underperformance. Warren Buffett's very good because he picks the individual companies that are value and at the right times. Don't just buy value stocks generally, because like I said, a lot of the time they're good value for a very good reason. This is the long-term underperformance. You can see here data from MSCI World, from MSCI. You've got value and you've got global stocks. You can see the underperformance is significant going back from May 2005. Now we look at the same index, the MSCI World, and the blue line now is MSCI World Quality. Huge overperformance this time. So again, from May 2005 to May 2020, you look at 418.99 versus 210.24. Quality is not a new phenomenon. This has been the case for many years now. Okay, now what else to invest in? I'm coming to the end of my slides, so we still have time for Q&A. I've I've kept unchanged this slide from last time. These three things are still things for me to look at. I guess China, you could probably add on Asia or ASEAN generally. I think that's a great long-term play. But for me, gold, China, and sustainable investing, ESG. Okay, ESG is environmental, social, and corporate governance. And it's becoming a bit of a buzz term now, actually. Gold, look, we're in an extraordinary time. There is political instability. There are so many different events that could happen or are happening, like COVID-19. Gold has a negative correlation to the US dollar, don't forget. With all this stimulus and printing, short term, I actually think the US dollar will strengthen again, but the long-term ramifications for the dollar is it's got to continue weakening. It really does. And it's diversification. It's a real asset, which is a reason not to use synthetic ETFs, by the way. Make sure whatever you buy holds physical bullion, as there's no point. I mentioned in my last seminar, if it dips below 1700, it's definitely worth a buy. It actually did that about a week later, and it's now up to, I think it's about 1780. So it's doing what I expected. Again, any short-term dips, I'd say, is a good opportunity to get into gold. Just make sure the ETF you buy is not synthetic. And domestic China. I've put domestic in big capitals. I think this is important. We all look at China, like I said, lots of negative press, but the domestic economy is strong. There's a huge opportunity there. It's a very tactical, strategic government with a huge population, with very much emerging affluence. It's not wealthy. The GDP per capita is not massive at all. But China's in better shape than most of the world. It's actually insulated from most of the global economy, despite what we think. They've been back to work for a while, although there's fears, obviously, of the second wave. They haven't yet really released the big guns. We haven't seen ridiculous levels of new stimulus come out of China like we have in the rest of the world. And consumption's picked up. And look, this is what the market's doing. You can see it's lost a lot less and is actually a lot more stable than the rest of the world. ESG investing, again, this is just from the MSCI. The blue line is the All Country World Index with ESG added in to the filter. And you can see there's an outperformance that's only just starting in the last few years. For me, this is very much a new trend. ESG is going to continue outperforming. There's the whole millennial mindset, I guess. People spurn oil and gas, for example. People want gender diversity on boards of directors, etc. Like I said, this isn't a new trend, but it will become a big outperformer, in my opinion, for years to come. So this is definitely something to look into. And I can talk separately about this another time. We'll speak to you individually. We're all conscious of climate change and stuff now, right? So this is just something, all of our mindsets are changing, and this will filter through to the investing world. Okay, so we've got 4 minutes left. I'm going to leave you with this diagram. Now, this is pulled, I think we've all seen one version or another of this. And, you know, this is like a general market. This isn't real data, it's a general market. Now, obviously, we'll be here, sort of pre-COVID. I don't want to scare people, but the question, I guess, is, are we here, or are we actually only here? Do we still have this to come? Second wave of COVID, the recession hitting? That's something to bear in mind. I don't know the answer. I suspect we're possibly here. But actually, I think these two lines will be different lengths. But let's see what happens. So I'm not here to scare people, but again, this diagram you can see in real history. The top here is the 2011, you can see. Again, we have this little relief rally or bear market bounce. Same, 2008, 2009. You can see here, we have this little bounce. Are we here? That's the question. Maybe we're here today. who knows? Let's see. Like I said, I'm not here to scare people, but I think that's the general backdrop. I finished 2 minutes early. I wanted to finish 10 minutes early. So look, any questions, contact your advisor, or feel free to email me. What I'll do is I'll take Q&A now. I'm going to leave this slide up because I think this would probably be good, thought-provoking for Q&A. But where I think it's good to invest, I've added in about the pet-related, luxury consumer gold, China sustainable. And then I think the only thing I could add around this area is probably that extends into biotech and robotics. And this is going to be a big area. This is definitely a long-term theme. So, right, I'm going to see if I can build up the Q&A. Let's see. Okay, so we've got a question in. You can, please, everyone feel free. If we don't have time to, if you need to go, we'll be sending out a recording, don't worry. If you can stay, I'm happy to stay within reason for the next 15, 20 minutes. And look, if we don't get a chance to answer all the questions today, then I'm happy to email or have phone calls or a private Zoom, and we can do this again. So we've got a question here. Are there ways to invest in companies not listed on the stock market? Yes, is the answer. It's not typically what we do or what I do, although ironically, I'm looking at a non-listed investment just this week, in fact. But typically, no. I think most people, and certainly our clients, wait till something is actually on an exchange. We access them via an ETF or through a managed fund. At the moment, I would use managed funds, as I've said. But there are ways, and another thing to look at that has started picking up, whether it continues or not, is the IPO market, initial public offering. So when companies first go to market, you can actually invest pre-IPO, although they're typically quite big ticket sizes. You can invest at IPO, and then of course, you can invest in the open market from there. So, okay, the next question. Okay, so you talk about quality investing. Is that something that's just done well recently, or is that something that can continue? Okay, well, I believe it can continue. I'm just going to try and find the two relevant slides because this is the main one. So again, what you can see here is quite clearly, it's not just this, pandemic period. It goes back to 2005. You can see value here and quality here. The outperformance is staggering. It's massive. And I really, I can't see why that would change because like I said, when you think about it, it's the most basic and obvious form of investing. Would you invest in a business that has a competitive advantage, high margins, is profitable, has no or low debt, strong management, and looks after shareholders? Yes. I mean, you always would, right? The only thing I would say, and this goes for any type of investing, is just be cautious, particularly with this K. Be cautious if things get overvalued. Some of the consumer staples is a good example on this because they've been great. Everyone's at home, everyone's worried, people buying cleaning fluids, they're stocking up their larders and fridges and freezers. And of course, consumer companies have seen great results. And you see that in the market. So the market realizes that this is the case. However, maybe people have already stockpiled. So are their results going to be worse? What about the effects because restaurants have been closed? Maybe this hasn't been factored in fully. So you do still need to look at whether things are too hot, if there's a bubble, perhaps. But no, for me, quality is definitely always the way to go. Okay, we've got a second question here. Is this the correction? And if it is, how much lower will it go? Good question, because, well, we had a, -7% drop about 10 days ago. We had a drop last night. Honestly, the answer is I don't know. If I go back to this slide, this is, again, hypothetical, but as I showed, it does reflect very real historical data. So I guess the question is, could we be at this bit here, this new fear and capitulation? The answer is I don't know. Probably the most debated thing right now is, obviously, can the market keep going up? That's one thing. But if it is coming down, will we just see a correction of 10, 12, 15%? Are we going to go back to the bottoms that we saw before, back to these levels? Or are we actually going to go through the bottom and see a new one? Of course, I don't know the answer. I do very strongly believe that we have to see a correction, and possibly it's just started. For me, it's always been about July. The month of July has always been important because you get GDP data that will confirm a recession, but you also get the corporate earnings. So look out for the second and third week of July. You get lots of corporate earnings. They're going to be bad, we know that. But like I said, the biggest concern for me is the lack of forward guidance that the majority of companies simply won't be able to provide. And for me, that's not a backdrop for a bull market. I don't believe we're in a bull market. I think we're very much still in a bear market. This has been a bear market bounce. Can it continue? For sure. I think the second most Googled phrase in the last 2 weeks is "don't fight the Fed." And don't. That's one of the big reasons why the market keeps going up. But I do feel, and I feel the time is any time now, that we'll see a correction. And I said, I don't know if it's going to be minus 15 or if it's going to be minus 50. I really don't. But again, it goes back to invest in tranches or use the dollar cost averaging strategy. Because for sure, in some ways, I hope there is another correction. Because remember, recessions and corrections are investors' best friend. It gives you the opportunity. If you missed out before, it gives you the second bite of the cherry. If you did take advantage and you've got new money, great, you've got more opportunity to build up these positions. Because at some point, let's get back to the big picture graph. Markets always recover. And you don't want to have just cash sitting by the sidelines, waiting and waiting and waiting and waiting. Like I said, many people have been waiting all the way through all of this. Look, that's the last bull market, S&P 500, 527%. It's food for thought. Okay, questions. All right, no more questions. There are still 16 participants. Any last questions? Happy to take now. If not, like I said, please feel free to contact me offline. You'll get a recording of this session. And yeah, we can always do another one. I think it seems to be quite popular. So any questions? Any last ones? No, okay. Well, look, thank you for today. Hopefully you found that interesting. I've tried to present reasons to be positive, but also I think, like I said, I don't want to scare anyone, but reasons to be cautious, I think. But ultimately it comes down to the strategy. Like I said, whether you invest in tranches on a regular basis or just top up your existing portfolios, or all three, do it, because not investing is unfortunately the only way that you guarantee losing money, because interest rates are below inflation. They're negative in some countries. And actually inflation is quite possibly a knock-on effect from having these lockdowns. I think we could see inflation. We are going to see probably tax rises around the world. So people need a return. So yeah, don't wait to invest, just invest tactically and invest in all of the right areas. And hopefully quality continues to go up. Okay, that's it for me. Have a nice evening or nice day wherever you are in the world. And yeah, look forward to speaking to you again soon.